If you own an options contract in a stock that is about to split, you have to watch this video first. Okay? So here's the things that I think are super important for people with options contracts that are about to split. I'll give a couple more people some time to come on and then we'll go. Say in the chat for me if you know a stock that is about to split. There's a big one that was announced this week. Do you all know it? Tell me what company is about to split. Yes, yay. Hey guys, y'all are saying Nvidia and Chipotle. Yes, exactly. So Nvidia this week announced that they are going to split. They're going to do a 10-for-1 stock split. So for every one share of their company, you'll now have 10 shares. And then for Chipotle, for every one share of their company, you'll now have 50 shares. Yes, they're doing a 50-for-1 stock split. But the question is, if you already have options contracts, what happens to your options contracts? So I've done some research and I want to break it down for you here in this video. I had to do this for myself too. I was like, I wasn't sure. What does happen? So first thing you should know is there's an options clearing center. I was about to say options clearing house, but it's options clearing center, OCC, and they will automatically do this calculation that we're about to go over in the video here. They'll automatically do it for you. So if you have options contracts, you don't have to worry about manually going in and changing anything with your contract before the split date, or like I need to sell everything before it splits. You don't have to do that. They will automatically do something called making you whole. So being whole, they'll make you whole and they will do the calculation and configure your contracts with the stock split. So you don't have to do anything, but I do think it's still important for you to know what's going to happen. Anybody else curious like I was? Like, okay, if I own a contract of Nvidia on June 6th when they do their split, what happens? What is it going to say in the computer? Well, let me show you. And hey, welcome in everyone. I'm glad to see you. If you know anybody who's interested in options contracts or owns some, feel free to send this to them and press like and subscribe on our channel. So first of all, let me show you the natural like math behind a stock split. So let's look at a couple things here. I'm gonna share my screen. You guys know I'm a teacher by nature, so I'm gonna share my screen and we'll actually look at some things. But I wanna first show you just the math of what will happen with the actual split. You all know this, but if you don't, when the stock splits, the valuation of the company doesn't change. So the math is still going to add up the same way before and after the split. However, you'll go from having a smaller number of shares to having a larger number of shares. Likewise, with the options contract, you'll go from having potentially one options contract to maybe 5, 10, a bigger number of options contracts. And another spoiler alert, another thing is when the split happens in the shares, the stock price goes down. That'll be the same thing on the options contract side. Your strike price will go down. So after the split, you'll have more options contracts and a lower strike price, but the expiration date will stay the same. And anything else about it? Most everything else about the contract will stay the same, but you'll just now have a lower strike price and more contracts. But let's still look at the numbers so that it really makes sense. All right, here we go. I'm gonna share my screen. Okay. So you guys should be able to see, I'm pulling up, do you guys see this here? I'm pulling up a big spreadsheet. Okay, yes, y'all see it. All right. So first of all, let's look at the number of shares and the stock price for both Chipotle and Nvidia. Since Chipotle, their split is supposed to happen around June 25th, And then Nvidia's stock split is happening around June 6th. So by the day of June 7th, you should see the difference in price for Nvidia stock. So let's say one share of Chipotle, we're going to say like what it is now versus after the split, what the share count will be. So right now, if you have one share of Chipotle, Chipotle is going for $3,151.63. For easy math, because you all know between now and June 25th, the stock price will go up and down. So let's, for ease for ourselves, let's say $3,000, because that's going to just make everything easier. So let's say that by June 25th, it's Chipotle stock is at $3,000. So that means if you had one share at $3,000, the total value is 3,000, right? Now what's going to happen, and I know this might be a little small. Let me make this a little bigger for you all. At least I'll make it bold or something. Here we go. And this stock price is $3,000. So the total value of your one share is $3,000 by June 25th. Now, when they do their 1 for 50 split, now instead of having one share, you're actually going to have 50 shares. So after the split on June 25th, you'll now have 50 shares. However, the stock price will also be divided by 50. So the share price now will be equal to 3,000 divided by 50. So now each share is worth $60. But you would see inside of your brokerage account, okay, I now own 50 shares of Chipotle at $60 per share, but the total value is still going to be 50 times 60, which is still 3,000. So you guys see how the actual amount, the value is not changing. You can have one share over here of Chipotle at $3,000, and your total value inside of your account is going to be $3,000 for that asset, that share. Or you could have 50 shares at $60, and now the total value is still $3,000. So that's what we mean when we say the value actually doesn't change. It's just the number of shares and the stock price. Now, your question may then become, well, Teri, and here, I'll stop sharing for a second. So your question then may be, okay, Teri, if I did this stock split, or like what would be the point? Why would they even do a stock split if the value doesn't change? And honestly, it's because once those stock prices come down, so at $60, they think more people will be able to access the stock. And when you have more buyers and people able to access the stock, then the stock price can continue going up again, because that's just the nature of the stock market. It's buyers and sellers. When you have a lot of buyers, the stock price will go up. When you have a lot of sellers, the stock price will go down. So they're thinking, if we make our stock price lower, then we'll attract more people to buy, and they'll keep pushing the stock price up. At $3,000 per share, not very many people can afford this, and we can't attract new investors. Does that make sense? But after June 25th, the value will stay the same. And what I've seen over time, I've been trading now for about 14 years. What I've seen is after the split, you may see a little bit of a sell off because people sell the news, right? So after the split, it may come down a little in price. That'd be a good time to then get into it. And you assume that more people will be attracted and the stock price will continue to go up again. Okay. Yay. So let's actually go ahead and calculate the other one. Let's look at the shares of Nvidia and how they're doing. So I'm going to share my screen again. It's not quite as easy as doing it on Zoom. I'm learning how to do this on YouTube. All right. So here is the price for Nvidia. Right now, it They just had earnings. They announced this big stock split. They announced that they were doing really well on their revenue. They also announced that they were increasing their dividend. So, full steam ahead on all aspects. They are really in charge of our AI. So, anyone who's thinking about the AI movement, they're excited about Nvidia stock right now. And they have run up even before their earnings, they were up 90% for the year. And now they're even higher than that. So they said, you know what? Again, we want to attract more people to keep buying at this $1,000 level. It's going to be hard for people to afford our stock. So they're going to do a 10 for 1 stock split. So let's look at our calculations over here. So for Nvidia, let's say we had 1 share of Nvidia. And let's round this off too. So by June 6th, so you have a couple weeks here, what will the stock price be? Let's assume that the stock price is around 1,000. Honestly, it may keep rising. So we could even have assumed that, okay, by the time it splits, it'll be at 1,100 or even 1,200 could be our estimate. But for now, for just ease, let's say that it's at $1,000 by the time that it splits. So that means the current value, if we were to own 1 share, is, and I actually should do all of this as formulas so that when we switch up the number of shares, it'll move. But here, I'll start now doing that. So right now, the value is going to be the number of shares. So this cell times the stock price, which is $1,000. Which equals 1,000. And the reason I did this is because now later on we know that one options contract is 100 shares. So if you had one contract and your shares are actually 100 shares, now this is your value, right? So we'll be able to play with that in a minute. But for now, if you have 1 share of Nvidia, your stock price is $1,000 per share. The total value is 1,000. I'll make this big for us. After the stock split, so on this side, they're doing a 10 for 1 stock split. So now you're going to own 10 shares, and the stock price will be the 1,000 divided by 10. So instead of owning the shares at 1,000, now you have at 1,000 divided by 10, which is $100. So now you have 10 shares of Nvidia at $100 per share. Let me put dollar amounts on these. Uh-oh. I would actually have to change the format to add the dollar amount. We'll keep going. This is numbers. Anybody else on here prefer Excel? When I'm like super trained in Excel, but numbers, I'm like, ooh, where do these things go? All right, so that means that the total value, our new total value is going to be the number of shares. So now we have 10 and our times our stock price, which is 100. So it's still the same. It's still $1,000. You have $1,000 over here currently, which is 1 share times $1,000 per share. Total value is 1,000. And then after the split, you're still going to have $1,000 value, but you have 10 shares at $100 each. Really exciting. I'm excited to see this because it'll be fun to compare how Nvidia then performs against Amazon and Apple and Google, who are now all in that $100 to $200 range because they've gone through stock splits themselves. In the past, Amazon was over $3,000, and then they did a stock split, and now they're hovering around, let's even do, I think it's like 180 maybe. Yep, 180. I just saw it flash. So around 180 at the time of this video. But they've done a stock split. They went down in price, and then same thing. Now more investors are able to get to it and we can see it. So now let's calculate what's going to happen if you had an options contract. So let's go back over to our numbers chain, and y'all still with me? And actually, here, any questions so far before I keep going? Q Moore said Nvidia is going to run after this. Potentially, yes. I think it's possible for it to have the stock split. Now more people can get into it and it go back up to 1,000. That would be the hope, right, for any investor. But we can't say that for sure. We just know now it'll be a smaller price and more people will be able to get into it. I do think though, because you have more shares, it's going to move a lot slower. This is another just pro tip from 14 years of investing. What's the difference that I've seen in stocks before and after a split? The movement is a lot slower. So you all know one of my best days in trading stocks was with Amazon, but it was back when it was in the 3000s. At that time, it could move like $100 a day. And literally, my best day, I made over $1 million in a trade on Amazon, and it's because I had 100 options contracts, and then it moved $100 that day, right? So it was really easy to actually see a lot of movement at the same time. Now, with Amazon down in the hundreds, it may move. We have a study that we like to follow called the average true range, the ATR. It tells you how much a stock moves per day. The average true range for Amazon is a lot smaller. At times, it can move like maybe $3 to $6 in a day or less sometimes. And because of that, it's a lot harder to see unless you have a lot of shares. It's a lot harder to see the big gains that we used to see. So that's something that you should consider. Like after this stock split, it may not move as much as it used to move, and it might be a little harder to make some of the returns you're making at the current level while it's trading at 1,000. Okay. Before I keep going, we move to the option size. D. Bowden said, "What day do we buy the stock split? Same day or next day?" As I mentioned, I think after the news, so after the stock split, you'll probably see a little bit of a drop in price because, after the news in anything for stock seems to be a day where everybody is like, okay, the news happened, fun is over, bye. We're selling and running with our, our gains. So you'll probably see a little bit of a drop in that price before the stock price goes up. So I'd actually wait till after the split, see what happens. Like it's okay. As an investor, that's one of the biggest things I've learned. It's okay to see what happens instead of guessing beforehand. So after I do this with earnings too. See what happens at earnings, see what they say, see what happens to the stock, and then decide if you want to invest in it. A lot of people will play the guessing game before earnings, but you really don't know what the company is about to say. So that to me, that's a little bit more of a like a risky thing to do with your money because you really don't know before earnings. But see what happens. If there's a pullback, like they have great news, but the stock still goes down, now you know you have a legit opportunity to invest. I would do the same with the stock splits. See what happens after the split. Wait maybe a couple days even, and then decide to get in. Okay. All right, now let's go. Okay, good. Everyone's like, gotcha. Okay. Now let's go over to look at our options contract and see what's going to happen to our contracts. So first, let's come up back over to our math. I'm gonna do an entire screen again just because it's easier for me. You might see a little bit of a second of seeing everything, but okay. So now let's look at our math one more time. In our original math, we did one share. But if you own a contract, your contract is 100 shares. So let's see first, try to see the best way to explain this. Okay, we're going to leave this up here with our number of shares. No, actually, we're not. Let's say we have 100 shares. No, okay, never mind. I was trying to figure out how I want to explain this. So let's say, for example, we'll do the math. We'll just leave that there and then do the new math. So if we have a Chipotle contract, so this is one contract of Chipotle. Our whole little our whole little table here is going to be slightly different. So I may just even write some different things. But when you're doing options trading, the thing you need to know is like first, like how many contracts do I have? So like the number of contracts. Then you need to know what your strike price is. Because those are the two things that are about to change when we do this move. So let's say, for example, and let's go look at the options chain. So like all of these columns might switch up a little bit for us, but we'll do the math together. So if we have one contract, let's just say we have one contract of Chipotle, and let's say our strike price is still 3,000. So what that would look like over here on the options chain is here's an options chain of Chipotle. And here in the middle, I'm not sure if you guys, can y'all see me? Okay, good. Yeah, y'all can see me. All right, here in the middle, it says strike price. And then it tells you the bid and ask. So this is how much you're actually paying for your options contract. So this is the premium. This is the strike price, etc. So for us, if you were going to be in this trade and experience your options contract changing, that means that your expiration would need to be after the split, right? So if our split is happening June 25th, then we actually, right here's the expiration. We need to go down to something past June. So let's say that we had an options contract that expired June, July. Let's look at August and just see what we see. So let's change our expiration date up here. Let's go to August. And great, I'm so glad that they show us. So right here, if you had a strike price of 3,000 and your bid and ask, you would actually be paying this side. Like one of the things in options that's really confusing is usually the bid, which is this side over here, is used for buyers. So if you're buying something, then you're putting in a bid and you're telling them how much you want to pay. In options, that's going to be on this side. But this side is where sellers are saying, okay, I'll sell it for this much, but it's showing how much the buyers want to pay because that's how much the sellers can sell it for. On the ask side, if you're a buyer, you have to pay what the sellers are asking for. So you're going to come to this ask column and you're going to say, okay, if I want to buy a contract of Chipotle, I'm going to have to pay what the sellers are asking me. So it's going to cost me about $269 per share in order to buy this contract. And each contract is actually worth 100 shares. So when you're buying this contract, you would move the decimal over and it would actually cost you $26,980. So $26,980. But what this is saying is, okay, I will sell. This is what the seller's basically telling you right here. They're telling you, okay, I will sell 100 shares of this to you for $269 per share. So to be in control of this contract, you can pay me this much. Oh, we can go into too much detail if we go if we go into the actual contract. So let me switch this back again. So we're in August. At 3,000 strike price, and we're going to pay $269.80. So let's go put these numbers into our Excel sheet. Now, a couple things that you would learn in trade and travel is that we never pay full price. So even if this is what the sellers want us to pay, I'd probably put in something less than this, maybe even go in the middle between the bid and the ask. And I would offer something like maybe around 260, 263, and you most likely would get accepted for this contract. But you would say, you know what, I want this contract at $3,000 per share, and I want to pay. And you put in what you want to pay when you're placing your order. But for the point of this, we just want to know what's going to happen to our options contract after the split. So let's just put in our numbers. Okay, so we have one premium. So we have one contract. Our strike price is 3,000, and they're going to ask us to pay $269.80. For ease, let's say that they're asking us to pay 269. No, let's do the whole thing. No. Sorry, I'm talking to myself, but I'm like, no, that's gonna be hard for you guys to learn. So the premium on this is, I believe it was 268, right? Let's look one more time. So 3,000, no, 269 and 80 cents. Okay, so 269. 269 per share. So let's talk this through. And I'm working through this at the same time as you all. I know where I'm going, so follow with me. But some of this might be kind of like, what is she writing? I'll bring it all together at the end. But in one contract, if we wanted to get one contract of Chipotle at the strike price of $3,000, the premium on it is 269 per share. So that means that the cost to us, and let's actually make this a little bigger. Come on, numbers. So the cost of this option, total cost for us is going to be 100, because it's 100. Okay, let me come back and explain. It's a little different. So when you have one contract, one options contract, that's 100 shares. So what you have to then say is, okay, I have one contract, but the premium is 269 per share. So the actual cost for me is going to be 269, which is this premium, times 100. So that's how much I had to pay for this options contract, is this $26,900. So for me to be in control of 100 shares of Chipotle at $3,000, it cost me $26,900. Okay? Now here's the thing. I told you that in the stock splits, the value of what you have invested is going to stay the same before and after the split. So the options OCC council, they're going to make sure that after the 25th, this 26,900 still stays the same. But what will change is the number of contracts that you own and the strike price. So these two things will change, this number of contracts and the strike price, but it's still going to end up adding up to this 26,900. So this is where we have to come and say, okay, let's do the math so that we see how many contracts we end up owning. So let's do it. Before we had one share of Chipotle, and we times it by the strike price or share price, and it told us how many shares we'd own now. We need to come through and actually figure out how many shares will we own after the stock split with our contract. So right now, to calculate the number of contracts, right now with this one contract, we're in control of 100 shares. But Chipotle is about to do a 50 for one stock split. So after the stock split, how many shares will we own with this contract? we'll have to say 100 times 50, right? Because 100 shares, and actually maybe let me add a column here just so that you guys can understand what I'm saying. I wanted that column to actually be on the other side. I want it to be here. So we can say number of contracts, number of shares. So with this Chipotle, we have one contract, but that actually is 100 shares. And the strike price that we selected was 3,000. It'd be better if this had a dollar sign. And the premium that we had to pay was $269. And this is premium per share. So the cost that we paid was this premium times the number of shares, which is $26,900. Y'all got it? After the stock split, we're going to now have to multiply this number of shares to include the split. So now after the stock split, we're going to have 100 shares times 50. So now we're going to have 5,000 shares. So that one contract that you had is now controlling 5,000 shares. But the number of contracts is not, like, how many shares per contract isn't changing. We're still limiting to just 100 shares per contract. So what we would figure out now is say, okay, 5,000 shares, divide that by 50. Let's do the math. So this 5,000 shares, excuse me, not 50, divided by 100. So we now own 50 contracts. Does that make sense? And I could have just said, okay, one contract times 50, but that's not actually how it's working, because you're not timesing the contracts by 50, you're timesing the shares by 50. So in a second, when we do Nvidia, that contract math wouldn't work. You can't do 50 times 1 for the contracts. You have to calculate how many shares will I have, and then say, okay, well, it's 100 shares per contract. So now how many contracts do I have left? Let's do that again down here with Nvidia, just so that we can show that same math. And in a second, we'll go back through and calculate the new strike price. So you'll have a new number of contracts and a new strike price. And y'all tell me, can you still see my screen? I can't see you, so I just want to double check. Yes, okay, you can still see my screen. All right, so let's try to calculate the number of options contracts we would have in Nvidia, because they're doing a 10-for-1 stock split. So before, we have one contract, which is 100 shares, and then the strike price on Nvidia would be so their stock split is like June 6th. It'll show up June 7th. So we would have to own a contract after the 7th, right? But let's, for consistency's sake, let's say that our expiration was in August for Nvidia as well. And let's do it. We said $1,000 was what we were calculating before. So August 16th at 1,000. The price that we would be paying is underneath the ask column here, so 125. So we'd be paying $125 per share in order to control a contract at $1,000 strike price for August 16th. So let's go enter that in. 125. That made it real easy for us, huh? 125 at $1,000. All right, so let's go do our math. 125 at $1,000. And I know I'm moving kind of fast, but because it's YouTube, y'all can always rewatch this video. And I'll sum it all up at the end. So right now, the strike price we were doing was $1,000. And the premium, it would cost us $1.25 per share. I'll make that a dollar sign. So that means if we have 100 shares, the cost of this is going to be 100 times 125. But let's just do it by the cells, by 125. So it cost us $12,500 to be in control of one contract that's expiring August 16th at $1,000 per at $1,000 strike price. Now, let me pause for a second because some of you all don't know much about options. And this video really is for those who know options, right? Because you have an options contract. But someone's probably wondering, like, what made us pick that strike price? So there's a lot for trade and travel students. There's a lot that goes into picking our strike price. We would be using a chart, and we would be trying to find out when's the best place to buy the stock. And then we would use that to figure out when's the best strike price to put to place. But what the strike price right now is saying is if we bought a call of like an options call at $1,000, we start making money when the stock price goes above 1,000. So what we're basically saying when we buy a call is we think that the stock price is going to go above $1,000 by expiration. So if our expiration is August 16th, we're basically saying, okay, by August 16th, we think that the stock price of Nvidia is going to go above $1,000. And our goal would be for that contract to gain in value. So right now we're paying $125 for that. So we break even on expiration date if Nvidia goes above 1,000 plus what we paid, plus the 125. So if Nvidia goes above $1,125, then we break even by expiration. But in the meantime, if it goes up, like let's say it goes to 1,100 in June, well, now this contract that we have guaranteeing that we can buy, so this is giving us the right to buy shares at $1,000. This contract that we have now goes up in value. And so now instead of being worth $125, if the value of the stock goes up, then the value of our contract will now go up and the premium will be worth more. So that's kind of what we're saying. We're saying if you buy a call of a stock, you're saying, I have the right to buy this stock at the strike price. So I have the right to buy 100 shares of Nvidia at $1,000. My thought process is if it goes above $1,000, well, now this right to buy, which is the contract, will also be worth more. And I can sell the contract for more money too. Okay. So that's kind of what is happening behind the scenes in options contracts. But let's still focus on what we came to focus on is how many options contracts will I have after the split? So if you had one options contract of Nvidia, it controls 100 shares at $1,000. The premium price you would pay per share is 125. The value or the cost to you is this. Sorry. Is $12,500. Now let's calculate how many contracts we will have after the split. So first we have to come in and say, well, we have 100 shares, and for each share, we actually get 10 new shares. So now we're going to have 100 times 10, which is 1,000 shares after June 6th. Okay? But an options contract only is 100 shares per contract. So now we're going to have 1,000 divided by 100, which is 10 contracts. Now, like I said, you might think that you can just multiply one contract times 10 for the split, But it's not always going to be that easy because, like, let's imagine that you had, like, imagine they did like a like a 2 for 3 split, or like a 1 to 5 split. It's these are kinda easy for us because the numbers are so easy, but there might be a time where the splits are a little different, so I don't want you to just go by multiplying the contracts, because the contracts are in batches of 100. So, make sure that you figure out the number of shares that you now own, and then say, "Okay, well, each contract is 100 shares, so how many contracts do I now own based on the number of shares that I own?" Okay? Just so you can make sure that your math is always right. Now let's go to strike price. We will now divide the strike price by the split amount. So now instead of having $1,000 strike price, you're going to divide this by the split. So that means that you're going to do 1,000 divided by 10 because we're doing a 10 to 1. So now your strike price will be $100 instead of $1,000. So you'll now have 10 contracts at $100 strike price. And then in options, they're going to make you whole. So we'll also divide this premium by 10 as well. So this 125 divided by 10. So now each one of your contracts is $12.50 per share, and you'll still be made whole. So now you will have 1,000 shares times $12.50, which gives you the same price. So remember here, when we had one contract, we only had 100 shares. So we would times this 125 by 100 to say how much it's going to cost us. Now we have 10 contracts, but 10 contracts means that you're controlling 10 contracts times 100 shares. So you're controlling 1,000 shares. So you're going to now times this 1,000 shares by your premium price. And you're going to, this means that the value that you have in the market is still the same. So this is how they're going to make you even. So now if you own a contract, so this is basically what our video is about. If you owned one contract of Nvidia, now after the split, it's going to show that you own 10 contracts. Your new strike price is going to be $100 instead of 1,000, and then your premium will go down as well. The cost for each one of those will be about $12.50. So your all-in cost, this is what they call by making you whole or being made whole. Your all-in cost will be the same as it was before. So you shouldn't see any big changes in your account after the split, except that the stock price is actually going to move. But in terms of just the actual calculations, this is what the OCC, um, the options center will be doing on the back end, and they'll actually automatically do this for you. And your strike prices and premiums will all be calculated. They have a certain like end date. So for example, on Nvidia, June 6th, at the end of the market that day, that's when they'll look at all the pricing, look at the premiums, and then they'll decide based on those prices what these new costs need to be by the 7th when they show up in your account different. Okay. Let's calculate for Chipotle. So let's calculate the strike price. The strike price is going to be the current strike price divided by the split. So the split is 50 for one split. So we're going to take this $3,000 strike price and divide it by 50. So now your strike is going to be $60. And you're now going to have 50 contracts. We calculated that earlier. You're now going to have 50 contracts instead of one. And then the strike price will be $60. But then let's also calculate your premium. So the premium was $269. Let's divide that by 50 as well. So now you're going to own 50 contracts at a $60 strike price, and the new premium for each one will be $5.38. See, like this is where things become much more attractive, right? Like up here at 269, it's a bit hard to own the contracts up here. But at $5, well, now it only costs you $538 per contract. So let's calculate our value now. It should still be the same, but we now should be able to have this is I'll write out this formula in a way that might be easier for you to understand. So now we have 50 contracts times 100 shares per contract times $5 and was it 38 cents per share. That's the premium. So then that's how we would get the same cost. So your cost is still the same. The 26,900 is going to stay the same after the split. But now you have 50 contracts and your strike price is different. Let me see if I can make that bold for you. These are the things that changed. And the premium price changed too. Okay. So do you guys have any questions? And I'm going to do one more summary on this. I'll see what questions you have, then we'll do one more summary. And was this helpful? I hope so. I was wondering, this was a big question for me too. Like, what if I have an options contract and there's a stock split? What happens to my contract? Well, now we know. You'll have more contracts at a lower strike price, and they'll switch your premium price as well, but the cost that you paid will stay the same. So you shouldn't see any changes in your portfolio in terms of how much like money you have invested for that stock. Let me stop sharing and see what questions you have. Okay, hey Drew. Okay, so Drew says, "Hi Terry, I was at the dinner you hosted at Trade and Travel Live last year. Good to see you, Drew. Can you touch on how the stock split impacts the Greeks?" So I don't know for sure how it will impact every Greek, but I will say so. Like I don't know how the delta is going to change now that okay for every dollar that this moves, will the delta switch? I'm actually not sure the answer of that. We'll have to check and see, and maybe this time I'll pay more attention so that in future stock splits I'll be able to answer that question. But I will say, and I said this a little bit earlier, after the split the stock moves less. And that's something that I really did notice on the last few splits. Like when Amazon, Google, and all of them Apple did their splits, they just move a lot less. So it's a little harder to make the big, crazy gains that we were making before because they move less. But I'm not quite sure how that impacts like the delta and the theta. So we'd have to check. And yes, Colette says in order to get the stock split, you'd have to own the stock already. Yes, you do. So, for example, I believe I think this is Chipotle. You have to own the stock by June 18th for them to recognize the split on June 25th. Now, honestly, though, like if you owned it on the 19th, I wonder what they would say. And I think the stock market is closed on one of those days. So maybe that's helping helping. And the June 19th is actually my birthday. Shout out to all the freedom babies and the fact that June 19th is now a holiday. But yes, you do have to own the stock beforehand in order to participate in the split. Oh, good. Monique said this was absolutely helpful. Oh, good. My preference, I see in the comments and questions here, my preference is to buy a stock after the split. But for some of you all, like I said, you own an options contract and maybe you own a leap of an options contract, or your expiration on the options contract for Nvidia or Chipotle or whatever stock you're trading is not until a few months later. So the question is, well, what happens? Here's the answer. One, you don't have to do anything. The broker will actually change everything in the computer for you. there's an options clearing center that will make sure that you are made whole. So that means that whatever money that you invested into that original option, it will look like the same amount of money after the split. They'll just switch the numbers. And then we saw, and I'll show this again in the calculations. I'll do just a quick little wrap up. Here's how the numbers will change. So let's look down here. If you guys can see me. So let's look down here at this Chipotle. So first, before the split, if you had one options contract, you now will have 50 options contracts of Chipotle. And the reason why it changes is because one options contract is in charge of 100 shares. Let me say that one more time. One options contract controls 100 shares of the company. So for this Chipotle trade, they're doing a stock split that says for every one share, you get 50. So that means with your contract, you're now going to control, instead of 100 shares, you're going to control 5,000, which is 100 times 50. Because you now control 5,000 shares, you have to divide this 5,000 by 100 because each contract still, that part didn't change. Each contract only covers 100 shares. So now you say, okay, well, I own 5,000, or I'm able to control 5,000 shares. That means I now have 50 contracts because 5,000 shares divided by 100 gives you 50 contracts. So we've now done the math for everybody for Chipotle. If you own one contract of Chipotle, you'll now own 50 after the split. Now, the next thing that's going to change is the strike price. Whatever your strike price is that you have the option for, you need to divide it by the stock split amount. So for us in this, we calculated $3,000 was our strike price, which is kind of close to the current price at the time of this video. We divide that by 50, and it gave us that the new strike price for our contracts is going to be $60 per contract. Okay, because we did 3,000 divided by 50. I just don't know how to format these in numbers so that they're dollars. I'll have to play with that later. But this should be $60. The next thing we had to check is our premium price per share. When we had the one contract with a strike price of 3,000, and this is I'm calculating all these for calls, but you guys can also do this for puts and other options contracts. The premium that I currently paid was $269. I divided that by 50 as well because we're doing a 50-for-1 stock split in Chipotle. And so now the strike price or the premium that I was paying is $5.38. So when I did the math, the new math, my 50 contracts at a strike price of $60 per share with a premium of $5.38 would end up costing me the same amount as my previous contract. And the reason why is because you calculate, okay, 50 contracts times 100 shares per contract gives you 5,000 shares. And you times that by the premium per share, the $5.38, and that gave you the price. So really the only thing you need to know is if I owned a contract beforehand of Chipotle, after the split date, I'm now going to see in my computer that I own more contracts at a lower strike price, and the premium for each one of those is less. But the amount of money that I spent is going to be the same. So that part won't change. Next, let's look at Nvidia because it's a different split amount. So on Nvidia, we said, okay, if we owned one contract of Nvidia, that covers 100 shares. And for this purposes, we said $1,000 strike price. But your strike price might be different. Maybe you have a strike price of $950, or you got in at a really great price a long time ago maybe you got in at 700, right? Or something less. And your expiration is not until far away. Well, put in your strike price, and then you need to divide that strike price by 10 because the stock split is 10 for 1. So take your strike price divided by 10. For us, we did $1,000 strike price. So that divided by 10 was 100. So our new strike price is 100. And when we calculated the number of shares that we had, we now have 10 contracts. So for the one contract that we did have at 1,000, we now have 10 contracts. I'll bold it at $100 strike price. And then we have to go to our premium. Well, how much are we paying per share? They just divide that by the strike amount, the split amount as well. So $125 divided by 10 means that now I'm paying $12.50 for every share. And when I times it by the number of shares, I have 1,000 shares. So that times by the premium price per share means that my cost on this is $12,500, which is the same as it was when I owned just one contract. You guys see that? So that's how you calculate the options that you will have and the number of contracts after your stock split. So let me come back, come off, stop sharing one more time, and see if there are any last questions. Colette, you just figured out how to watch me on your smart TV. That's great. But now I'm about to be finished. You guys are welcome. I hope this is helpful. Like I said, please put a like on here and also subscribe to our channel if things like this are helpful. And if you own options contracts, don't be afraid to keep them through a stock split because you're still going to have the same number of same amount or value, but they'll just now give you more contracts at a lower strike price, which is actually going to be really great if the stock starts going up again. So that's no problem at all. All right. Well, goodbye, guys. Hope you do well, or hope you are doing well, and hope you have a great week. Bye.